Insurance guarantee associations serve as a vital safety net that every candidate must understand for the life insurance national exam, because they represent the final protection for policyholders when an insurance company becomes insolvent. When you see this topic on your exam, the first thing to remember is that these associations are established by state law to protect policy owners, insureds, and beneficiaries against the financial failure of an admitted insurer. The term admitted is a major keyword. Only companies that are licensed and authorized by the State Department of Insurance to do business in that specific state are required to be members of the association. This means that if you encounter a question about a surplus lines insurer or a non-admitted carrier, you must remember that their policyholders are not protected by the Guaranty Association. The way these associations are funded is a favorite subject for exam writers. You will likely see a trick question asking if the state government or taxpayers provide the money for these claims. The answer is a firm no. Guarantee associations are funded through assessments levied against other solvent admitted insurers in the state. In simpler terms, the healthy insurance companies are billed to cover the losses of the one that failed. This is a private funding mechanism mandated by law, not a government bailout. You also need to be prepared for questions regarding coverage limits. The exam will test your knowledge that the protection provided is not bottomless. While the specific dollar amounts can vary slightly between states, the national exam generally focuses on the concept that caps exist. Typically, you might see a limit of $300,000 for life insurance death benefits and $100,000 for cash value or annuity surrender values. If a policyholder has a $1 million policy, the association will only pay out up to the specific state-mandated limit, leaving the remainder as a loss for the beneficiary. One of the most important regulatory aspects to master is the advertising prohibition. It is considered an unfair trade practice and is strictly illegal for an agent to use the existence of the Guarantee Association as a sales tool or an inducement to purchase insurance. You might see a scenario where an agent tries to reassure a client about a company's financial stability by mentioning that the state will cover them if the company goes under. On the exam, this is always a violation. The state wants consumers to choose companies based on their own financial strength, not based on a collective safety net. To keep these rules straight, use the mnemonic GAP. G stands for Guarantee of Admitted Insurers Only. A stands for Assessments on Solvent Members. P stands for Prohibited Sales Talk. Another area where students often get tripped up is the scope of coverage regarding different types of products. The association generally covers life, health, and annuity contracts. However, it does not cover the investment risk portion of variable products. If a variable annuity loses value because the stock market crashed, the Guarantee Association does nothing. It only steps in if the insurer itself can no longer meet its contractual obligations. Furthermore, entities like fraternal benefit societies and self-funded employer plans are often excluded from these protections. Always look for the distinction between the insurer failing and the market fluctuating. Finally, remember that coverage is typically provided based on the residency of the policy owner. If you live in a state, you are covered by that state's association, regardless of where the insurer was originally incorporated. Keep these distinctions in mind to avoid common exam traps.